Good afternoon, traders. I'm Himalay Bhatia from the Financial Analyst, and I welcome you to the Bold Project. In this module, we are discussing about the Dow theory. In the first episode, we discussed about the first principle of Dow theory, that is, the stock market discounts all information. In the previous episode, we discussed about the second principle, that is, the stock market has three trends, and we discussed one part of it, that is your primary trend. In this episode, we will be talking about the secondary and the minor trend. Now, before I get into the details of the secondary and the minor trend, let's quickly recap what we learned in a primary trend. So, in the primary trend, we learned that if the market is making higher highs and higher low structure, then we say that the market is in an uptrend, or we can state it in market terms as a bullish trend. Similarly, when the market is making lower highs and lower lows, then we say that the market is in a downtrend or it is in a bearish trend. And why is this important? Because this helps us predict where or how the reversal is happening in the market. All right, now let's talk about the secondary and the minor trend. So, for the secondary and the minor trend, what I first want you to do is to imagine a picture that I will be giving you. Let's all imagine that we are sitting on a moon, and we are sitting on the moon and we are looking towards the earth. Now, what will we see? We will see the earth as a whole, correct? Now, what I do is I pull out a telescope and I zoom into this earth. Now, what will I see? I will see that the earth has been broken down into various countries, correct? Now, what I do is I zoom in further. What I see is that these countries are further broken down into smaller cities. Now, this is nothing but your illustrative representation of your primary, secondary, and minor trend, where the earth as a whole represents the primary trend, the countries represent the secondary trend, and the cities represent the minor trend. This also indicates that the earth as a whole, which is your primary trend, shows us the biggest picture in the market. The secondary trend, that is your countries, represent a decent picture in the market. And finally, your minor trend, that is your cities, show you the smallest picture in the market. So now my question to you is, what trend, according to you, is one of the best trend for a trader? Stop this video right now and think about it. And then you can resume this video and listen to what I say. All right. Out of all the three pictures, the primary trend is one of the most important pictures for a trader. This was discussed in a previous episode as well. The theory clearly suggested that a trader should always and always trade in the direction of the primary trend. Why? Now, the reason being, it shows us the biggest picture. It is showing us the entire data of an entire world. That means we can easily trade in that direction, and all the factors in the world are factored in. But if we look at the minor trend, then that shows us the worst picture in the market. Why? Because it is just showing us a limited data in the market. It is just showing us a small picture, and that constrains the trader from taking accurate trades. The major events that are happening around the globe or in the country are not getting factored in the smaller minor trends. Now, don't confuse yourself. If you think that minor trends are for intraday traders and primary trends are for maybe investors or swing traders, then that is incorrect. In the previous episode, we saw that primary trend can be applied on any time frame, be it your 5-minute chart, 15-minute chart, day chart, month chart. In each time frame, the primary trend can be applied and be identified. So it is not that the minor trend are for intraday traders and the primary trend are for swing or the investors. So how do we go about the secondary trend now? So from this illustration, it is also pretty evident that the minor trends, that is your cities, are found within the secondary trend, that is your countries, and your secondary trend, that is your countries, are found within the earth, that is your primary trend. So each trend is found within each other. So let's take a detailed analysis on what our secondary trends are. Now let's take a look at this diagram over here. Over here we have point A. Now what is happening at point A? At point A, the prices of the stock are very cheap, and it is the human tendency to buy something which is cheap and which has quality, right? So what the traders do or the market participants do is they buy the stock at point A. Now, if there is buying at point A, of course, demand is increasing, and this is just a basic economics. If demand increases, your prices increase. So the prices increase and reach point B. Now at point B, what is happening? At point B, the market participants are comparing the price with the actual events that are going around in the world or in the country. So what they feel is that the prices are currently overvalued, and what they do is they start selling the stock. Now, if selling increases, that means your supply increases, and if supply increases, that means your prices will fall down and the prices come down to point C. Again, at point C, the market does this comparative analysis. They check the price, the current price, they check its fair value, and they think that the markets are now undervalued. They buy the stock again, and again, the demand increases, prices go up to point D, so on and so forth. The market moves. That is why we always say that the market never moves in a straight line direction, it always moves in a wave like manner. All right. Now, this was the human psychology behind the market. Let's talk about a few market terms over here. So the point D and B, which are the highs in this case, are also known as the correction points in the market. Now, why do we call this the correction points in the market is because from here, the prices are correcting or falling down. All right. Similarly, we have the point E and point C over here, which in this case are the lows of the market. Now, these are also known as pullbacks in the markets or are sometimes also referred to as dips in the market. That is why we say that, buy at dips. You must have heard this term. Why do we say buy at dips? Buy at dips means the lows that is being created in an upward trend. So over here, you can see that point from A to F, the primary trend is in an upward direction, but the secondary trends, that is your point B to C and point D to E, are your secondary trends. These are small corrections in the market. Similarly, let's talk about this picture. My main primary trend over here is from G to L, right? And it is in a downward direction. And in this direction, what is happening is we have points I and K. I and K are again known as your correction points in the market. And the point H and J will be known as pullbacks in the market. So what is important to us? In an uptrend, corrections are important, and in a downtrend, pullbacks are something which are important. So over here, whenever there is pullback, we say that we sell at a rise. So your correction points are also known as the rise in the market. All right. Now let's take a live example from the charts. So the orange line that, or the orange trend line that has been plotted over here is your primary trend. And let's take a look at the secondary trend in this case. So the secondary trends over here are these that you find in between. All right. What is important in an uptrend? Are the pullbacks important? No. The more important trend over here is the correction. Once the correction happens, we have to buy at the pullback. We don't have to sell at the corrections. Corrections are important in an uptrend and pullbacks are important in a downtrend. That is how we traders are able to take profitable trades in the market. So all these small waves in between are your secondary trend in this case. I hope that is clear to you all. And from this picture, it is also pretty evident that your secondary trends are found within the within the primary trends. All right. Now, before we move on to the minor trend, let's try to discuss the difference between an investor and a trader. So what is the first difference between an investor and a trader? An investor is a person who blocks his capital in the market for more than 1 year. 1 year or above is something which is termed as an investor. Then comes the traders. Who are the traders? Now, people at a majority know only about one sort of traders, that is your intraday traders. Intraday traders are those people who buy and sell the stock within the same given day. But many people don't know that there are many other sorts of traders as well. The second sort of traders are known as your scalpers in the market. Scalpers are people who hold the stock for a couple of minutes only. They also a part of intraday traders, but they are separately known as scalpers in the market. The third type are known as your swing traders. Now, swing traders, what they do is they hold the stock for a few days to a few weeks, depending on the trade in the market. And finally, there's something known as positional traders in the market. Positional traders are those people who hold the stock for a few months, but anywhere below 1 year or 12 months. So these are the different types of traders that you should be aware about. And you should practice on all these different styles if you are a new person in the market and see which type of trader is suiting you. And all you have to do is just follow that type of trading. That's about it. All right. So this was the first basic difference between an investor and a trader. Let's talk about the second difference between an investor and a trader. The second difference is that an investor is focused on wealth creation, but a trader is someone who is focused on profit maximization. Now, that is something which is a very big difference. Don't get confused over here. I will explain you what is the difference. So let's first talk about a trader. What will the trader do in this picture over here? The trader will buy at point A and then sell at point B. He will again buy at point C, then again sell at point D, so on and so forth. So I can say that the trader tends to enter at pullbacks and exit at the correction points in an uptrend, right? Now let's talk about an investor. An investor, what he might have done? An investor would have entered at point A, but he will not exit at point B. Again, at point C, what will happen is if the investor has surplus capital, he will buy additional stocks at point C. Again, at point D, he will not exit. So, when does an investor ideally exit? So, investors usually exit in certain scenarios, and I will tell you a couple of major scenarios where the investors tend to exit. The first scenario is that if the investor, if his requirement is for the capital. So let's say if the investor is in a financial distress and the money that he has put in the markets, he has the requirement for that money. What he will do is he will square off his positions from the market, book his profits, and utilize that money for his personal use. So that exit can be any given point in time. It can be exactly at B as well, or it can be in a downtrend, or it can be in an uptrend. So anywhere in the market, an investor can exit. The second reason what can happen is the investor might be exiting from a stock is because either he has found another financial security or an instrument which is giving him higher return on investment with the same amount of risk that has in this security. So if he is getting a better return on investment, then of course he will exit from this security and he will put his money in some other security. All right. So again, that can happen at any given point in time. And thus we say that the investors do tend to enter at a pullback, but do not exit at the correction points. So this is a very important point you all should remember. So these are your secondary trends and how to trade your secondary trends. Now, let me quickly just summarize in your secondary trends. If the primary trend is in an upward direction, then we always use the strategy of buy at dip. That means once the correction has taken place, we buy at the pullbacks. Similarly, if the primary trend is in a downward direction or there is a bearish trend in the market, then we take use of the secondary trends to use the strategy of sell at rise. Sell at rise means we will take advantage of these secondary trends. We will wait for a pullback, and then once the correction is happening in the market, we can again take a short position in the market. What is short selling? That has already been covered in the other module. All right. So these are your secondary trends, and in the next episode, we will be discussing about the minor trends as well. I hope you enjoyed this lecture, and if you have any doubts, we will be covering those in your doubt clearing sessions on the weekends. Thank you.